Welcome to vTalkInsight, Allocator's Lens Daily for December 9th, 2025. Global markets are at an unusual crossroads. Equities hover near record highs. Copper and digital assets signal strong risk appetite, yet long-term yields remain elevated and global debt is piling up. With a widely anticipated Federal Reserve rate cut and unusually high internal policy disagreement, cross-asset relationships are in flux. Let's start with equities, where optimism around earnings and artificial intelligence is colliding with late-cycle stresses. In equities, the picture is still broadly risk-on, but the foundations look more fragile than index levels suggest. The S&P 500 sits just below record territory, and volatility gauges are only modestly higher, telling us investors still lean optimistic even as the macro narrative becomes more complicated. The dominant supports are well known. Markets expect a quarter-point Fed rate cut with very high conviction, and history shows that when the Fed eases with stocks near highs, returns can remain positive over the following year, albeit with choppier paths. At the same time, earnings expectations are robust. Forecasts point to low teens profit growth this year, around 9 to 10% next year, underpinned by 6 to 7% revenue growth and improving small-cap prospects. Leadership within equities is also broadening. After a long stretch dominated by a handful of mega-cap technology names, we now see rotation towards sectors such as transportation, global autos, materials, home builders, energy, financials, healthcare, and consumer staples. European equities are seen as tactically attractive on the back of better-than-usual growth and fiscal support in Germany, while Chinese shares have outperformed recently despite weak domestic demand, helped by a weaker currency supporting exports. Under the surface, artificial intelligence remains a central driver. Some corporates report 20 to 30% productivity gains, and one popular projection has AI-related equity market value rising many times over the coming decade. Semiconductor equipment names and select chip makers are outperforming, and deals like IBM's acquisition of Confluent point to an arms race in data and AI infrastructure. Yet dispersion is rising. Investors are increasingly differentiating between AI leaders and laggards, and upcoming results from companies like Oracle are viewed as key tests of whether AI CapEx is earning its keep. Against that upbeat growth story stand mounting valuation and concentration concerns. The so-called market darlings now account for nearly half of S&P 500 value, while contributing a much smaller share of earnings, and the U.S. overall represents a far larger slice of global equity market capitalization than of global profits. The implication is that a lot of good news is already in the price, especially in U.S. mega-cap technology. On top of this, technology has quietly become one of the most capital-intensive sectors. AI infrastructure spending is now comparable to, or higher than, what traditional energy majors invest, reducing flexibility for buybacks and raising the risk that valuation multiples compress if growth disappoints. Some observers describe the equity cycle as entering a late phase, with stretched valuations, peak earnings expectations, softening labor data, and weaker manufacturing all starting to bite. Policy and inflation dynamics magnify that fragility. Inflation is still running around 3%, and long-term expectations, such as those tracked by regional Fed surveys, remain above target. Markets have been assigning an 80 to over 90% probability to this week's Fed cut for some time, but the central bank itself is unusually divided, with the prospect of several dissenting votes. A hawkish cut is widely expected, a small move paired with messaging that further easing will be cautious and data-dependent. That combination, together with sticky long-term yields, could limit the boost to equity valuations. If the Fed were to surprise by not cutting, some estimates suggest a 1 to 3% drawdown in the S&P 500 simply from repricing stretched assumptions. More broadly, persistent fiscal deficits, rising global debt, and the risk of eventual debt monetization all argue that inflation could re-accelerate later, complicating the soft landing narrative that currently supports equity multiples. The balance of views is therefore nuanced. Many large institutions and Wall Street strategists remain positioned for further equity gains into next year and even into 2026, pointing to earnings strength, ample liquidity, and the AI investment boom. At the same time, others see the outlook trending gradually from better to worse, with expectations for future returns being quietly marked down from double digits to high single digits. For multi-asset allocators, this environment shifts the focus from broad beta exposure towards selectivity. Sector rotation away from crowded technology, regional diversification beyond the U.S., and greater attention to earnings resilience all become more important as dispersion rises. The key watch points are the Fed's decision and tone, follow-through in AI and cyclicals earnings, and how equities respond if long-term yields or inflation expectations move higher again. Those same forces are front and center in the rates market. Turning to rates, the front end of the U.S. curve is firmly priced for a quarter-point cut this week and additional easing into next year. Odds for an initial move are widely quoted between 80 and 90%, and some forecasts still pencil in around 3 cuts in total over the coming quarters before policy pauses. Yet this apparent certainty masks deep disagreement inside the Federal Reserve. Officials are split between those focused on downside labor market risks and those more worried about upside inflation surprises. The upcoming meeting could see an unusually high number of dissenting votes, underlining how contested the case for cutting is with core inflation still above target and survey-based expectations not yet fully anchored. The longer end of the curve tells a different story. Despite expectations for easier policy, Treasury yields remain elevated, reflecting higher term premia, persistent fiscal deficits, and heavy issuance from both the government and corporates financing investment and M&A. There is also a global dimension. Shifts in Japanese monetary policy and swings in the dollar are prompting some foreign investors to reassess their Treasury holdings, adding upward pressure to long maturities. At the same time, quantitative tightening appears to be in its final chapter. The Fed is expected to stop shrinking its balance sheet and allow it to grow slowly in nominal terms as the economy expands. Combined with a recent pickup in money supply, that raises questions about whether easing financial conditions might eventually reignite inflation even as headline components like shelter start to cool. Outside the U.S., policy divergence is sharpening. In Europe, key central bank officials have hinted that the next move in rates might be up rather than down, pointing to persistent core inflation, ongoing fiscal stimulus, and closing output gaps. That rhetoric has already pushed German yields to their highest levels since early spring and may force markets to reprice the assumed terminal rate path. In contrast, Switzerland is contending with very low or even negative inflation and a structurally strong currency. The Swiss National Bank may feel pressure to ease policy sooner, but its room to weaken the franc is constrained by external scrutiny. These cross-currents, together with speculation about future Fed leadership, are feeding in a higher term premia and keeping global long-dated yields from following the front end lower. Looking ahead, investors face a narrow path. One scenario sees inflation gradually drifting down while growth and real wage gains hold up, allowing yields to fall over time and validating a soft landing. Another centers on renewed inflation pressure from fiscal expansion, potential debt monetization, and an end to quantitative tightening, in which case long-term yields could stay high or even rise, challenging duration-heavy portfolios. Importantly, several analyses suggest that a small Fed cut may have limited impact on benchmark 10-year yields or mortgage rates, especially with heavy Treasury and credit supply still to be absorbed. That would blunt the transmission of easier policy to the real economy and leave rate-sensitive sectors under pressure. The way this tension resolves will be critical for credit markets, where spreads are tight and leverage is elevated. In credit, the surface looks calm and even constructive, but underlying risks are building. Spreads in many parts of the market, especially high yield, are hovering near local tights, implying very limited compensation for default or downgrade risk. Investment grade is also rich relative to history, helped by strong demand for income and still benign realized losses. Fundamentals to date have been more resilient than feared. The peak in default rates for leveraged finance appears to have passed, with the worst month behind us late last year, and capital markets remain wide open. Companies can still refinance, extend maturities, and fund acquisitions, which in turn supports equity sentiment and keeps near-term credit stress contained. Several trends are keeping the tone positive. Financial sector bonds are in favor as deregulation and a rebound in strategic deal making underpin earnings visibility and give investors confidence to move down capital structures in issuers they know well. A pickup in M&A is expected to run into 2026, fueled by AI themes, defense and healthcare spending, and a generally supportive macro backdrop. Large banks and intermediaries are also committing significant balance sheet capacity to strategic sectors like security, critical minerals, and technology infrastructure. That financing, together with accessible bond markets, means many corporate borrowers still enjoy multiple funding avenues. Isolated defaults are cropping up in weaker CCC loans and smaller private names, but so far these have not triggered broader contagion. The more concerning signals come from areas where transparency is lower. The boom in private credit is drawing attention, particularly for insurers and pension funds with meaningful exposure to lightly traded loans. There is growing unease that headline ratings may not fully capture underlying credit quality, especially in older acquisition structures, and that regulatory changes to bank leverage could reveal hidden fragilities. At the same time, global debt loads are climbing and large maturity walls are approaching, meaning more borrowers will have to refinance at higher coupons. Narrow spreads and falling cash yields below 4% leave little room for error if growth slows or policy missteps occur. Some observers warn that cutting rates in an environment of tight spreads and no obvious financial stress risks, encouraging misallocation of capital, fueling inflation rather than supporting sustainable growth. For allocators, the message from credit is that carry remains attractive on the surface, but the margin for disappointment is thin. Key watch points include how spreads react to the coming wave of corporate and sovereign issuance, whether the recent high in leveraged defaults truly marks the end of the cycle, and how private credit behaves if growth data weaken or rates fall less than expected. Signals from credit often lead broader risk sentiment. A decisive widening from today's tight levels would challenge the bullish narrative that equities and other risk assets are still leaning on. Currency markets are already reflecting some of these cross-border funding and policy dynamics. In foreign exchange, the dominant theme is a gradual shift away from U.S. dollar strength as investors look ahead to a more accommodative Fed stance. Several views anticipate the dollar resuming a weakening trend next year if the Fed delivers more cuts than are currently priced and if domestic purchasing power continues to erode under persistent inflation. The euro has already been grinding higher, recently approaching the mid-1 teens against the dollar. Major banks still expect further appreciation over the next couple of years, supported by improving global growth and, at the margin, slightly more hawkish European policy rhetoric. That said, any abrupt Fed pivot or renewed risk aversion could temper euro gains. Beyond the majors, emerging market currencies in Latin America and Central and Eastern Europe are seen as relative winners, helped by earlier and more forceful local tightening cycles and solid demand for local currency bonds. These higher yields stand out in a world where developed market real rates may be headed lower. Two Asian currencies also carry important macro signals. A faster-than-expected rise in Japanese yields could trigger a significant yen repatriation trade, unwinding popular carry positions and reverberating across risk assets, including parts of the crypto complex. Meanwhile, China's trade-weighted yuan has been weakening, which is boosting exports to regions like Europe and Latin America and supporting Chinese equities even as domestic demand stays sluggish. All of this feeds directly into commodity demand and inflation expectations. In commodities, copper sits squarely at the intersection of AI infrastructure, the energy transition, and the global growth narrative. Prices have surged more than 30% this year and now stand at or near record highs, reflecting both robust demand and persistent supply constraints. Demand is being pulled from multiple directions: electric vehicles, renewable power grids, and data centers associated with AI all require large and growing volumes of copper. Projections suggest global consumption could rise from around 30 million tons today to 50 million over the next 2 decades, while mine supply struggles to keep pace. Some analysts even see scope for prices to move higher if Chinese production stalls. Others note that part of China's elevated import activity reflects stockpiling rather than end demand, a reminder that the current exuberance is not risk-free. Precious and strategic metals tell a complementary story. Gold continues to attract both official and private demand. Central banks, including in China, have been steadily adding to reserves for over a year, signaling ongoing concern about fiscal trajectories, potential debt monetization, and the desire to diversify away from traditional reserves. Gold is thus functioning as both a risk-on and risk-off asset, benefiting from portfolio rebalancing as well as hedging flows. Rare earths and other critical minerals have become a strategic priority for policymakers, given their role in technology and defense and the concentration of supply in a handful of countries. Large institutions are directing significant lending towards sectors tied to security, critical minerals, and resilient supply chains. At the same time, upcoming Fed communications could create short-term headwinds for more cyclical commodities if a hawkish tone lifts real yields or the dollar, tempering some of the momentum seen in industrial metals and energy. How these forces balance will be an important signal for inflation-sensitive assets across the board. Across assets, the message today is one of cautious optimism layered over increasingly late-cycle risks. Equities are still enjoying a powerful earnings and AI-driven tailwind, with leadership broadening beyond mega-cap technology, yet valuations, concentration, and policy uncertainty leave little room for disappointment. In rates, the front end is convinced a Fed cut is coming while the long end stays elevated on fiscal concerns and heavy supply, keeping duration risk very much alive. Credit markets remain open and resilient, but tight spreads, rising global debt, and questions around private credit structures point to a thinner safety margin. Currencies are translating these shifts into a softer dollar bias, stronger euro, and selected emerging market FX, and complex dynamics for the yen and yuan. Commodities round out the picture, with copper and other metals reflecting strong structural demand, while gold and strategic minerals highlight persistent hedging against policy and geopolitical shocks. The key watch points now are the Fed's decision and tone, the behavior of long-term yields and credit spreads around that event, and how equities and FX respond if the policy path diverges from what is currently priced. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.